people are looking at it the wrong way around in the West. They regard gold as an asset which you either buy, you buy if it's going up and you sell if it's going down. But the reality is that what's happening is it's not gold going up. I mean, if you look at the purchasing power of gold over millennia, it's more or less held steady. Therefore, it's actually currencies going down, and that's the way to look at it. And when people actually realize that prices are not rising, but their currency is going down, then the currency is doomed. And I wouldn't rule that development out in the foreseeable future, in the next 1 or 2 years. I mean, obviously, I hope it doesn't happen, but I can't see how they can get off this course unless there's a radical change in political thinking. The whole world works on credit. People just don't understand this. And it's this credit which, unless you actually tie it to money in terms of its value, has the risk of losing all its credibility. And that is broadly the situation we're getting into. I mean, if you look at going back to the debt bubbles that governments are in, I mean, we can see that US debt to GDP is around about 130, 135%. Now, what happens if I'm right and we're in Smoot-Hawley 2 or about to go into Smoot-Hawley 2, then GDP is going to go down, okay? The purchasing power of each unit of GDP is also going down, but GDP goes down. And so what does that do to the ratio? Immediately, you're looking at 150% debt to GDP, government. So it's not just the amount of debt, it's also what's happening to GDP. We can see how deficits are going to continue. We can see how not only America, but you've got Britain, you've got France, you've got Japan, you've got Italy, you've got Spain, all the sort of G7 with the exception of Germany, who's got other problems, is in a debt trap, and falling GDP is going to make it considerably worse. And this is going to impinge on the purchasing power of these currencies, which are not attached to anything. I mean, the whole point about a gold standard was that, you attach the value of credit to gold so that the only risk in the credit is the counterparty risk that you have and the time preference risk, loans of any duration. So this is an extremely important point to realize. The credit system we have is not anchored to anything. It is therefore highly vulnerable to the sort of problems which we now face. And by vulnerable, I mean in terms of its purchasing power. I can't see any solution to this unless there is an extremely radical change. There is actually, I mean, you asked a question a little while ago about is there any hope sort of thing. Buy gold, obviously, which means selling credit, incidentally. You're not buying gold, you're getting the hell out of credit. But the other thing is that contrary to Western propaganda, the Russian and Chinese economies are actually in reasonable nick. I mean, particularly the Russian one is extraordinary. They've got 21% interest rates. That's the overnight rate at the Central Bank of Russia.
Gold isn't really going up. Your currency is going down. This perspective, famously articulated by Alasdair Macleod, represents a fundamental flip in how we should all look at gold. In the West, the investment community tends to treat precious metals like gold and silver as just another asset class, something you purchase when you think the price will rise and sell off when you fear a decline. But that lens overlooks a crucial detail. Gold's purchasing power is held remarkably steady over millennia. What's actually happening isn't gold surging to the moon. It's the fiat currency in your bank account gradually losing value. You can see this dynamic across centuries. Ask yourself, how many good quality suits could you buy with 1 ounce of gold in 1920 versus 2024? The answer is still roughly one high-quality men's suit. It's the same with daily essentials like a loaf of bread or a gallon of milk. Decade after decade, gold's capacity to purchase these items often remains steady. Meanwhile, the paper currency you hold in your wallet steadily depreciates. Gold's steady purchasing power is crucial to understanding why gold is a unique form of money. Governments can print more currency at will, but they cannot simply create gold by keystrokes. This is one reason why many astute observers believe gold is, in effect, the base money, and fiat currencies, including the US dollar, the euro, or the British pound, are mere derivatives of it. When you're examining the gold price, you're actually measuring the value of paper currency denominated against something that doesn't just vanish or multiply in supply overnight. One of Macleod's central arguments is that our monetary system as it stands is on shaky ground precisely because of rampant currency creation. The US Federal Reserve, The Bank of England, the European Central Bank, and the Bank of Japan have all engaged in extraordinary levels of quantitative easing since 2008. This money printing spree has ballooned government debts. Currently, the U.S. debt to GDP ratio hovers around 130 to 135% and threatens to move even higher if the economy stumbles. Here's the conundrum. If economic growth falters, GDP shrinks. But the mountain of debt remains, becoming even heavier relative to the size of the economy. As that ratio ticks higher, confidence in those government bonds wavers. Because modern fiat currencies are inextricably tied to that governmental credit system, a loss of faith in sovereign debt can translate directly into a loss of faith in the currency itself. The key shift in thinking is to realize that price inflation in daily goods isn't always about prices rising. Sometimes it's about the buying power of your currency falling. If people across the board awaken to this idea that their currency is systematically losing credibility, then we enter a feedback loop that can cause a runaway from fiat currencies, leading them to fail entirely. In a functioning gold standard, all credit is directly tied to a tangible anchor asset, gold. Loans and credit expansions are constrained by physical gold scarcity. But in today's system, credit is anchored to a piece of paper representing government obligations. When states continually expand debt and central banks keep interest rates artificially low, they pump more and more currency into existence, undermining the value of that currency. This phenomenon doesn't stop at your front door. It ripples across the entire global financial system. Historically, gold-backed systems limited governments' ability to print money. But after the final link to gold was severed in 1971, when President Nixon ended the Bretton Woods system, currencies found themselves floating freely in the ocean of speculation, unmoored from the stability that precious metals provided. With no intrinsic anchor, this credit-driven system resembles a game of musical chairs, one that continues as long as faith persists that newly created money will retain purchasing power. But if confidence cracks, the scramble begins, and the credibility of that entire system is at risk. The immediate impulse is to think, so do I rush out and buy gold tomorrow? The deeper question is, how prepared am I for a world where trust in fiat is slowly eroding? Are you diversified in real assets? Do you comprehend that gold, silver, and even certain commodities are not just paper price plays, but real-world hedges? Gold and silver are not merely inert pieces of metal. They're forms of real money that have stood the test of time. Politically, they bring discipline to a world drowned in endless credit. Personally, they can serve as a store of value for your family's future. This line of reasoning underpins the entire concept that precious metals don't go up or down nearly as much as your currency does. Embrace that viewpoint, and you might see the world of finance in a very different light.
But what they're finding is that the commercial banks are offering deposit rates of something like 18%. What's happening is that the high wage awards, because there's a shortage of labor, for skilled labor in Russia, anyone with a skill has been getting pay rises of 20% plus. And in some cases they've doubled over the last couple of years. So the result is that the rate of inflation is nowhere near the rate of wage inflation. It's running currently at about 8%, 8.5%. I understand from other analysts who sort of look at these things a lot more closely that the rate of inflation is likely to rise, but that's a sort of effect, if you like, of numbers dropping out of the back end, all that sort of statistical malarkey. But, look at Russia. Do you know what the income tax rate there is? 13%, flat rate. It does go up to 15% if you're a high earner. Corporation tax, I think, is around about 25%, which is sort of normal. And the debt to GDP, that's currently less than 20%. It was forecast to be over something like 22% this year. But amazingly, Putin's government has managed to run a slight surplus on the budget, despite all the war spending. The Russian economy actually is in pretty good shape. It could go onto a gold standard tomorrow. And indeed, I would suggest that the best thing it could do is go onto a gold standard at current rates. And particularly when you look at the relationship between gold and oil being, the principal export, if you like. The average price of oil since the 1950s, measured in gold, is roughly 30-40% above the current level of gold. This reflects, if you like, the fact that gold is rising or appearing to rise because of monetary effects, whereas this is not the case in commodities. They've yet to catch up. But gold, over a long period of time, does. It is a broad representation, if you like, of the commodity complex. So, this is a very good chance for Putin to go onto a gold standard. But I think the reason he doesn't is because the Chinese don't want to do it yet. I think they realize that they're going to have to do it at some stage. India, throws up its hands at the thought of this. They've yet to really sort out the whole of the Shanghai Cooperation Organization and BRICS complex in terms of monetary affairs. They're very much in a sort of intermediate situation. But we do know that China has got very substantial gold reserves in the government, not just in the central bank, but also in wealth funds, and also the People's Liberation Army is a very large holder. We also know that Russian wealth funds have also got gold. So the Russians have probably got about 12,000 tons. They can go onto gold standards tomorrow. But the reason that they won't is that they would immediately demolish the entire fiat currency system around the world by comparison. I mean, it would really be as simple as that. So I think it's the sort of deliberate act which would be just short of a nuclear war. But at some stage, Peter, they're going to protect themselves from a collapse in the purchasing power of the dollar. And so that is, I think, what is going to drive them to protect their own currencies by putting them on gold standards.
Macleod has often pointed out that countries like Russia and China seem better positioned than the West might assume. For instance, Russia's economy, according to Macleod's assessment and various other reports, appears more resilient than Western media typically conveys. We see aspects of this resilience in Russia's relatively low debt-to-GDP ratio, less than 20%. They also have comparatively high interest rates, and wage inflation there has been keeping pace with or exceeding consumer price inflation. Surprising as it may be, the Russian budget managed to come close to balance, even amidst war spending, while many Western nations struggle with ballooning deficits. On top of that, Russia and China both have been quietly accumulating gold for years, either through their central banks, sovereign wealth funds, or in China's case, even the People's Liberation Army. There are reasons to suspect that their combined gold holdings could be massive. Some estimates place China's real gold reserves in the tens of thousands of tons. This hidden hoard might give them the ultimate monetary weapon, the ability to abruptly back their currency with gold, toppling the precarious fiat-based system leveraged by the West. Macleod raises a tantalizing hypothetical. What if Russia decided to peg the ruble to gold at current market rates? This act could blow up the global fiat currency system overnight, as market participants would flock to the new gold-backed ruble, leaving the dollar, euro, and pound behind. Such a move would be catastrophic for fiat currencies in the West. Yet Russia hasn't done it, at least not so far. One plausible reason is that China, Russia's strategic ally, prefers not to unilaterally launch a gold standard. Beijing has its own timeline. Another factor is that declaring a gold standard prematurely might be perceived as an act of financial warfare, an escalation that could rival the aggression of more conventional weaponry. As Macleod puts it, it would be just short of a nuclear war. However, from a monetary standpoint, eventually, these countries may need to safeguard their own financial systems if the dollar and other Western fiat currencies falls off a cliff. The impetus would be self-preservation rather than aggression. If the West's economic meltdown leads to the dollar's purchasing power collapsing, Russia and China might see no choice but to salvage their own economies by instituting a credible gold standard. This would limit the fallout on their own citizens and ensure continued trade stability. If any major power reintroduces a gold standard, it would likely trigger a domino effect worldwide. Major economies reliant on the US dollar and euro might have to respond by repegging their currencies or unveiling their own gold or silver reserves. This chain reaction could unravel decades of the fiat currency regime. Don't just take Macleod's word for it. Jim Rickards, famed monetary analyst and author of Currency Wars, has repeatedly warned about a coming monetary reset. He believes that gold, because of its universal acceptability and proven monetary history, would be a prime candidate to backstop any new currency arrangement. Silver often shadows gold in discussions of monetary resets. Historically, civilizations operated on a bimetallic standard, with both gold and silver coinage. In fact, the U.S. Constitution mentions gold and silver specifically as money. If a new monetary system is hammered out among nations, there's a possibility that silver may also become part of that anchor. Some analysts, like David Morgan, known as the silver guru, argue that silver could see tremendous appreciation if the global system transitions back to an anchor of precious metals. Why? Because the supply of silver is more constrained relative to industrial and monetary demand. If governments decided that a portion of their monetary reserves should be allocated to silver, it could create a rush for physical metal. This scenario might sound fanciful now, but in 1900, a silver-based system wasn't the least bit strange. As history repeatedly shows, monetary norms can change swiftly. Critics may say that the idea of Russia and China adopting a gold standard is far-fetched. Yet even if it doesn't unfold exactly like that, the larger takeaway is that gold, and possibly silver, remain the ultimate backstop to faith-based fiat systems. When trust in the issuing government falters, gold stands as a haven. That's been true for thousands of years and will likely remain so. Think back to 2008 to 2009, when the financial crisis threatened the global banking system. Gold jumped significantly in response, as investors sought safety. Now imagine the scale of a crisis involving the potential collapse of major fiat currencies. Gold wouldn't just jump, it could make leaps that dwarf previous rallies, revaluing itself against depreciating paper money. Another question arises. If everything is so precarious, why haven't we witnessed a total currency meltdown yet? The global system is remarkably resilient, primarily because it's interconnected. As the dollar is the world's reserve currency, countries around the globe hold massive dollar reserves to facilitate trade. This creates mutual dependency. Many nations don't necessarily want to see the dollar dethroned quickly because they too rely on it for stability, or at least a version of stability. Additionally, the financial system is so large and broad that unraveling it takes time. Think of it like a supertanker in the ocean. It doesn't turn on a dime, but cracks can form, sometimes swiftly. If the narrative around the US dollar or euro flips from world's safest asset to avoid at all costs, the change could happen rapidly. Then the entire dynamic of gold and silver valuations would shift overnight. Look at how mainstream financial media treats gold. Generally, gold stories revolve around short-term price movements or the occasional commentary about safe havens. Rarely do outlets highlight gold's underlying role as the bedrock of monetary reality. It's just not the standard talking point for modern central bankers or popular news cycles. But narratives can and do change. In the 1970s, after President Nixon closed the gold window, gold soared from $35 per ounce to an eventual peak near $850 per ounce in 1980. That dramatic climb occurred because the narrative shifted. The world realized the dollar was not as ironclad as believed, and inflation roared. Today, we see central banks around the world accumulating gold. In fact, global central bank gold purchases reached multi-decade highs in recent years. This quiet shift might foreshadow a bigger tectonic event. After all, central banks generally buy gold to hedge against the potential meltdown of the fiat currency system they're part of. It's an ironic twist. The very institutions that produce fiat money are buying insurance against their own product's failure. So where does that leave us? Alasdair Macleod's commentary suggests that precious metals, notably gold and silver, stand on the cusp of reasserting themselves as the real money of last resort. The conversation about a currency meltdown, a gold standard reintroduction, or a new multipolar monetary order is no longer fringe conspiracy talk. It's becoming mainstream discourse as deficits balloon and interest rates lose their potency. Yes, it's crucial to remain balanced. Not every doom and gloom scenario materializes exactly on schedule, but the structural imbalances in the global monetary system cannot be ignored forever. Governments rarely orchestrate radical monetary reforms until they're forced by crisis. That's the lesson of history. Whether it's 1 year, 2 years, or 5 years down the line, the system is visibly straining. If or when a major financial break occurs, being prepared is worth more than chasing the gold price as it skyrockets. Physical metals, diversified portfolios, and an informed outlook can help individuals and institutions alike navigate the transition. Gold's continued resilience, despite decades of official and unofficial antagonism, suggests it's not just a barbarous relic, as Keynes once quipped, but a wise lifeboat for those prudent enough to climb aboard before the storm hits. Silver, too, presents an opportunity, especially given its smaller market size and its dual role as both an industrial and monetary metal. Stay engaged, stay curious, and question the status quo. It might just save your wealth and your peace of mind in the years to come.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.